Good morning, clients and traders. Welcome to this week's morning call. I'm Joshua, the head of research, and I will be giving you the outlook on markets along with my assistant Kenneth Ko. We put out a note kind of 2 weeks back, giving a strong warning that we were poised for a near-term sell-off in stocks. Sorry, there's a right. That we were poised for a near-term sell-off in stocks, and we've noticed that while it's been a mixed earnings season, we actually noticed that negative earnings momentum may have bottomed out, and that the forward-looking economic data was encouraging, and the asset markets price signals actually still suggest a bull run. Okay, so we actually view that this sell-off is a cycle, just a cycle down, and a near-term cycle down, and that the bull market for the moment is still on. And so we continuously reassess this thesis every week. Okay. Okay, so I will go through the global macro conditions, earnings momentum. My colleagues will then go through market technicals and intermarket picture, and then we will feature the offshore marine sector. Okay, for U.S. macro, I think the overall outlook is still positive. New orders for capital goods is still on its rebounding trend. Retail sales is pretty healthy. Unemployment insurance, as you can see, is the growth of that is turning negative, which means to say that fewer and fewer people are claiming unemployment insurance, and this means that spending incomes are likely to rise. Now, the only negative now is that housing starts has the rate of growth has come off, and that is because bond yields have been going up due to talk of Fed tapering, and of course an improving economy will have some effect on this. However, the price of housing is still relatively low and affordable, and that although I don't have the charts here, existing home sales are growing and healthy, and even though new home sales are slightly down. Now, existing homes are much cheaper than new homes, so I suspect the American consumer would probably be chewing up the existing home market before they really put some dollars behind the new home market. Okay, around the world we have the Eurozone coming out of recession. We have Japan machine orders rebounding very strongly, and then we have in China actually things may actually be starting to look up. Okay, this is our measurement of year-on-year changes of industrial production by volume and transport by volume. So it's the average of the year-on-year changes, and we've seen that on the whole, we have an improving picture. Now, globally, the global PMIs are a good summary, and they show that manufacturing is steadily in the positive, and services is sharply coming back. Now we want to talk about Thailand and Indonesia today because they are one of our core they are our core markets, and they have experienced some heavy correction. Now, one of the questions we ask is actually, is the Bank of Thailand too pessimistic on cutting its growth forecast? Now, Thailand has put into back-to-back quarters of sequential contraction. The second quarter is a lot less contraction than the first quarter, suggesting that actually the third quarter will probably be positive. Now, the Bank of Thailand has nonetheless cut its forecast because it has cited the fragile state of a global recovery, tepid domestic demand, and of course political risk, because there's an amnesty bill that is being pushed through by the government, and this risks delaying the 2.2 trillion Thai baht infrastructure plan. On the first point, we actually think the BOT is too pessimistic based on our G4 outlook, so we have gone through this already, and we are positive on the major economies going forward. On tepid domestic demand, we actually see there's a huge rebound in factory investments permitted. And so again, we think that we might see some positive numbers from here in the second half. Now, on the third point, we're not political analysts, so we don't really have a sense of whether this amnesty bill will be very detrimental to the 2.2 trillion infrastructure plan or not. But so on consulting our Thai colleagues, our strategist actually expects this point C to actually expects that by November this point should be resolved, and she thinks that the Stock Exchange of Thailand will rebound towards the end of the year. Now, Indonesia, I think, has heavier problems. The current account deficit will have trouble reversing because unless commodities change trend. Afterwards, Kenneth will go through the intermarket picture, and this is actually quite a possibility. All right, so when that happens, I think we will see fund flows coming back to Indonesia. But as it stands, we really need a commodities rebound to close the current account deficit. Now, the other thing is that inflation is high due to the end of the fuel subsidy. And because inflation is high, the market expects a rate-raising cycle. And in a rate-raising cycle, there's always the possibility that growth might be killed. Okay, I think this is what the market is worried about. However, there are some positives. The end of the fuel subsidy means that there will be extra 20 billion a year that the government can spend on infrastructure and education, which it has wanted to do for many, many years already. So the end of the fuel subsidy is a good thing, and the inflation that you see now is due to that, and is going to be not structural in nature, right? I mean, basically, once the economy prices in the rising in fuel prices, I think going forward, you're not going to see the same sort of inflation as the next coming months when year-on-year changes of inflation will actually reflect this increase in fuel price. Okay. Now, FDI is also up 20% year-on-year, and which signifies that Indonesia continues to be an attractive place to invest, where wages are still 3 times lower than China. Okay, so I think going forward, if private investors still think that Indonesia is a good place to invest, then and you combine that with the infrastructure plans that the Indonesian government wants to put in, I think the growth story for Indonesia is not over yet. Okay, and that the problems that we see now is not a game changer to that story. We remain positive on the JCI, but I think short-term technicals suggest correction is not yet finished. Okay, so Kenneth will go through this later. Now, in earnings momentum, we note that for ASEAN, actually, there's been a slight rebound, and hopefully this trend will continue. And I think that if we have a continued positive outlook for the G4 economies, I don't think there's any reason why this shouldn't continue. And if you look at the US, I think it's not a fantastic earnings growth, but it's still in the positive, just still trending positive. Okay, so I will now pass you on to technicals in markets.
Okay, thanks Josh. Thanks for the economic outlook. I'm Kenneth. I'll be doing technicals for today. Hope you guys had a good weekend. Okay, so for the outlook on the market, this will be building on what Josh has said. Well, for the US market, well, we've been having a correction for the past few weeks, but we still believe that on the longer term, equities still have legs. Today, we're going to actually talk about a downside target for Treasury yields. There are some small encouraging signs in the SME correction, but even though there are encouraging signs, the downtrend is still assumed until proven otherwise. We'll talk about that the industrial sector ETF may signal if the S&P is actually going to cycle down or not. And in summary, Asian markets look a bit weak on the short term. All in all, our strategy is to wait for the correction to finish its toll before going back in. Okay, for the US market weekly chart, you can see the long-term trend is still going up. We still believe the short-term correction is going on until proven otherwise. Okay, dwelling deeper into the US market, we see 3 weeks ago that price has indeed penetrated through the support line over here, and it's actually on our first support. We noted a few weeks ago that the downside targets are 1650, which we already hit, and we are, as expected, it's actually bouncing a little bit from there. Now, we need to see this consolidation, whether it can actually sustain itself. If it does break down again, the next target will be 1610 to 1620, which is this red zone over here. If that breaks, then this is the major support line over here, this blue zone over here. Okay, we believe a correction to this of this magnitude over here will be a great buying opportunity. Okay, but we need to look at this correction pattern here. If the price reverses and breaks 1650, then this will imply further downside. So keep our eyes peeled for that. We do note, however, some encouraging signs on this cycle is that even though the PPO has started, the black line has started to looks like it could turn up, okay, but it has not turned up yet. So we can't. This is not confirmed. This momentum indicator doesn't confirm an upswing yet. Even though the McLaren oscillator is almost close to zero, it's also not past zero yet. So it's too early to say that this is a cycle up again. There are some encouraging signs I want to talk about. Within this consolidation of the first support, we notice that the Russell versus S&P is actually not weak. It shows generally small outperformance, and that's actually encouraging for the longer term trend because it shows that people have not lost their appetite for risk, which means that they believe that the economy is actually improving. Okay, so that's good for the long term. Short term wise, we need to see whether the price confirms on a breakdown or whether it goes up. We note that it is still possible for the price to come down more just based on VIX levels. VIX levels is an indicator of fear, and usually the end of a correction is marked by a high VIX level. So we notice that this, in terms of VIX, we could still potentially go further down. Okay. Sector trends. So for the last 2 weeks, we noticed that yes, the cyclicals has turned down. However, tech in the industrials, materials, and energy is still outperforming the other defensive sectors. So this corroborates with our economic outlook that the economy is in recovery, and I think the markets know that. So this bodes well for the longer term after the short-term correction. Okay. Last week, I mentioned this is what the industrial chart looked like, and I said that in all probability, there will be a bounce off this level into the gap. And just based on a best guess scenario of the conditions, market conditions, that this is a possibility that we will drop back down here, complete a small head and shoulder pattern to get to this level over here. Just to update, and this is based on weakness in some of the breadth indicators over here. To update, this is the chart as it is today. As you can see, we indeed had really bounced off over here into the gap. Almost perfectly to my arrow, but so now we need to see if this move here has enough momentum to actually break through the gap and continue. If it does not, right, then this is likely to happen over here. And just based on volume alone, it seems that this might not have enough momentum to push over here. Now, since industrials is actually leading the S&P right now, if this actually breaks into a head and shoulder pattern to this level here, this will probably trigger a equivalent correction in the S&P itself. So I think it's a good idea to look at this ETF and see what's going on this one. Keep our eyes peeled on this. Okay, intermarket relationship. So same story, bonds have been on an uptrend for years, and now we've seen great weakness just in the past few months. So we still believe that this pattern over here is a consolidation, and we are still biased towards the downside. Okay, so stocks are still in the uptrend. We still believe that commodities are consolidating for another move up. This is not a prolonged downtrend, but sometime it will start to move up. So at the same time, we also note that looking deeper, more closely, we look at the commodities and we know that it's actually short-term bullish. It's really challenging this downtrend line many times. It's actually bullish on the short term. So we need to keep our eyes peeled on this. Here, as you see at the treasuries, we've been challenging this consolidation low. We've since bounced out, but we are still at the consolidation low. So we need to actually see the resolution of this pattern over here. We are still, but the configuration of this pattern is still bearish. So since bonds are bearish, stocks are up and commodities look like it's got legs to go. We still believe in phase 4 of the business cycle. In this phase, on the longer term, you want to be short on bonds, long on stocks. We suggest that after the correction is over, that materials and energy sector will probably outperform the S&P. So please consider getting into these two sectors and long commodities. Okay, today we're going to talk about the downside target for bonds, and this is based on spread. So if you're going to go short on bonds, what's a good target to shoot for? So rather than just looking at chart patterns alone, this gives you a more quantitative downside target. This is based on the yield spread. So if you look at the top left, this is a graph of the yield spread between the 10-year treasury and the 3-month bonds, or the long and short rates bonds. As you can see right now, the spread is 2.75, but we noticed that for the past 20 years or 15 years or so 20 years, that historically this maximum spread has always topped out at 3.75. This is the maximum spread over here. Okay, so since we know that short-term rates are not going to change much, as the Fed has said for the next 1 or 2 years, only the long-term rates can move. So what we can do is, this is the 10-year treasury yield as today, okay, and the spread now is at 2.75. So we are saying that if you're bearish, it can move to another percentage point up here. Okay, the spread can move by another percentage point, and if you do that, then the target would be right here. This is your target if you're bearish on bonds, your immediate target. Okay. Now, if you want to use a more conservative measure, this particular spread is the spread between the yield curve and the 2-year bond. So it's a different spread. It's more conservative, and you notice that the spread is only maximum spread is around 2.75. If you're using this particular spread as your guide, then the target will be here at 32.5. So within this zone will be a good place to put your target should bonds continue their bear market move. Okay, and note, this assumes that short-term rates remain unchanged. So if short-term rates actually increases as well, then you have an even better target. Okay, so this is a good estimation to put your target in. A good way of playing this, a way of playing the bearishness on bonds, is to buy the TBT, which is a double short leverage ETF for the 20-year treasuries. The 20-year treasury is actually heavily correlated to the 10-year, so it can be done. So you will buy this and you will wait for the yield to go into this region before thinking of whether you want to take profit off your trade. Okay, sector glances. I just want to point out something very interesting. Now, we've been talking about sector rotation for a while, and now we see a practical example, observable example of sector rotation in motion. Now, we note that in the idealized sector rotation, cyclicals are supposed to outperform first, followed by industrials, materials, and energy. This is the idealized cycle. Okay. Now, if you look at cyclicals, you see that the relative strength has been increasing versus the S&P since March. So cyclicals have been leading since March. But we note that industrials, which is next, look at the pattern. It only started to really lead starting from May. From May, that's when it reversed and started to lead. Okay. For materials, you can see that it started to lead in July. So July is when it actually started to turn up. And energy, well, it's never really led. And it looks like it could basically turn up soon. So we notice that, yes, the relative performance of the sectors from the S&P seem to lag by 2 months. 2 months seem to be by 2 months. So if this pattern continues, should this pattern continue, it implies that materials and energy will outperform the S&P for the next couple of months. So that's why we suggest that after the cycle sell down is over, you might consider proxying into the energy and materials sector as an investment. Okay. Note that all these tickers are ETFs in their own right. Okay, this pattern also suggests that the end of the full stock market bull cycle is not yet over as well, because at the same time utilities has been underperforming and consumer staples. Okay, so this corroborates to where we think we are around here, phase 4 strategy, where you want to be in basic materials and energy. Okay, Asian indices, we do a quick summary. Okay, for the Thailand, there's been some weakness, as you know, it's all in the news. We see quite aggressive downside move over here, right? And we've hit our first support zone, which is a Fibonacci plus a support zone over here. So based on the strength of this move, we have to assume that it's bearish, short-term bearish until proven otherwise. So short-term bearish and probable downside targets will be here, 1260 to 1300. Okay, this red zone here is a very probable target. I believe the price should actually hit here before it can even decide to rebound. Okay, now if this gets penetrated, this red zone, then this Fibonacci level as well as this zone becomes your next support zone. Okay. On a closer look, you see that the down move has been quite aggressive, and because of this aggressive down move, right? Yes, you know, we have to be bearish until proven otherwise. I would be cautious in this market. Although on the long term, building on what Joshua has shared, that we are still bullish on Thailand. Okay. Equivalent story for the Jakarta markets. We notice a very aggressive down move, and this down move even broke this multi-year trend line. So this is quite significant in my opinion. We have bounced off conveniently on the 61% retracement, okay, of this whole move over here, the last impulse move. Okay, so that bounce was expected. However, because of the aggressive nature of this penetration, we have to believe that unless some game-changing macroeconomic news in India comes about, that any bounce off will be temporary. So if, let's say, markets recover from here and goes up, I think there should be one more leg, possible to be one more leg down, okay, unless the price can aggressively get back over this gap region. Unless we can aggressively get over this, I'm going to assume that there is further downside. So we should be cautious on this market. For the STI, same. We have last week we had a big down move into the support zone. Okay, so we're almost to the most probable target. I mentioned that a move towards the end of the support zone, which is this level here, would be a good buying opportunity, and we're almost there. So let's just keep our eyes peeled on this. So right now we are at support right now, and we should see if this support gets taken out, because if this support does get taken out, then the probability of hitting the bottom support zone is extremely high. So please keep your eyes peeled on this level over here. Okay, we hope for STI to resume its uptrend, basically it is to stay above this line. Okay, so maybe conservative investors should wait for a stronger basing pattern before buying. Okay, that's it for the market technical outlook, and now I'm going to pass you to Nicholas, our analyst, to talk to you about O&M.
Hello, testing. Thank you, Kenneth, for sharing with us. Today we will be talking about OMN season takeaway for 2Q13. First, let's take a look at Rig Builders. For Rig Builders, Keppel Corp's results were mostly in line. Earnings were down year-on-year, mainly due to a drop in revenue recognition for its sales of reflections at Keppel Bay and lower volume of work in its O&M segment. Sembcorp Marine's result was slightly below expectation due to conservative recognition for its new rig designs, and in terms of operating performance, Capital Corp's O&M margin remains solid at 14.2% in 2Q13, while Sembcorp Marine's operating margin eased slightly from 13.7% in the first Q to 13% in second quarter, supported by a gain from disposal of PPE of $13.7 million. We believe Sembcorp Marine's margin will continue to be under downward pressure going forward as it starts recognition for its second Brazilian drillship and new design well intervention semi-sub rigs, which will yield lower initial margins. While the fundamentals for the O&M sector remain strong, management from both Capital Corp and Sembcorp Marine sees competition from the Chinese and Korean yachts is beginning to intensify and may put pressure on margins going forward. That said, we think that downside risks to Singapore yachts are limited in the near term due to better pricing secured. Indeed, Singapore yachts have managed to raise pricing by about 14 to 21% for the proprietary design since early 2011, even though the Chinese peers have aggressively entered the offshore market with low pricing and attractive payment terms. In addition to the recent prices, we believe Singapore yachts can continue to benefit from some productivity gains from executing on numerous repeated designs over the past few years. This, in turn, should support margins. Over at the small mid-cap space under our coverage, Izion reported solid quarterly results driven by new projects contributions and steady margin. Its gross margin remains steady at 46.3% in second quarter versus 45.9% last year. This is also slightly higher than the first quarter's 44.9%. We continue to like Izion for its good business model and high earnings growth visibility via its SEU fleet expansion with firm contracts already secured. In contrast, ISRA's reported a disappointed set of results, no thanks to its subsea segment due to delays in project execution and additional unexpected cost recognition for certain projects. This leads to a sharp drop in gross margin from 16.7% last year to 0.7% third quarter this year. We expect downward pressure on ISRA's margins for the next few quarters as it may still take some time for its subsea segment to fully integrate the AMC business. Overall, we continue to reiterate our top pick within our OMM sector, Capital Corp. Allow me to run through with you 4 main reasons why we should invest in Capital Corp. First, its global yacht network. Industry consultant Wood Mackenzie sees deepwater drilling activity and spending rising significantly over the next decade from $43 billion in 2012 to $114 billion in 2022. This in turn will require 95 additional deepwater rigs to be constructed between 2016 to 2022, representing investments worth about $65 billion. Capital, with its near-market, near-customer strategy, has a global network of over 20 yachts, which allows it to be in constant close contact with customers and their markets. We believe this will allow Capital to benefit from the growing deepwater capex spending over the next decade. Next, resilient OMM margin. We note that average prices for its proprietary KFL B-class jackup rigs have been on a general uptrend since bottoming in 2010-2011. In specific, prices have increased by more than 10% from throughout levels of $180 million to current pricing of around $205 to $210 million per rig. Furthermore, Capital's product mix, which was previously rather mixed, also sees jackup rigs becoming a stronger contributor to its order book year to date. This will be positive to margins going forward due to higher productivity and efficiency from the construction of similar rig designs. Since the majority of 2014-2015 revenue will be materialized from contracts secured at higher pricing in 2012 and 2013, we believe Keppel's O&M margins should remain robust going into 2014-2015. Third, good dividend yield. Historically, Keppel has a payout ratio of around 40 to 60%. We believe its stable earnings and steady free cash flow should help dividend yield to remain strong at about 4 to 5%. We are assuming a payout ratio of 50% in our forecasted years, and currently it has an attractive dividend yield of 4.6%. Fourth, new product offerings. On the last quarterly briefing, management said they are showcasing a new drillship design to oil majors and operators as an alternative to Korean yachts design. Feedback from operators has been positive, and Keppel is confident it can offer a compelling alternative to current ones in the market. Given the increasing competition in other segments, we believe it's a prudent strategy. As for the FLNG FEED study for Gola, which is announced in November last year, it is expected to complete in 3Q this year. This is Keppel's first FLNG-related contract and represents a potential growth segment for Keppel as well, as there are currently no FLNG in commercial operation at present. We believe penetrating into new product areas like drillship and FLNG can be a strong re-rating catalyst for Keppel going forward. This is Keppel's financials in brief. Do note that Keppel is currently trading slightly above its historical average long-term PE of 10.7 times. This is a brief snapshot on Keppel. That's all we have today. Thank you very much. Questions?
Okay, let's do the O&M first. Oh, Ultramarine, but you don't cover it. Okay, there's a couple questions. Do the couple questions.
Alright, there's one question with regards to Keppel Corp. What is the good entry price for Keppel? Well, our target price for Keppel is $12.25. A good entry point will be around $10, $10.10. Right. With regards to the your question on U.S. shale gas production, well, from what we get from the industry specialist, industry consultant, currently shale gas production is still at its initial stage, so we don't see as much. There may be upside going forward, but currently it is still not as it will not affect oil price much.
Hi, this is Lucas. There's a question on asking us to provide an update for the REITs segment. Currently, it is still should still focus on team plays. Weakness will still be in the residential and industrial REITs. Okay, look more towards office and look more towards hospitality for the upcoming upcoming 2 to 3 quarters, because their performance will most probably outperform because they are relatively not affected by the cooling measures as compared to the other segments within real estate and REITs itself. So, yep, focus on hospitality, focus on office. Yep.
Hi, we have a question on, by the fact that we think, in terms of market cycles, commodities have not made a huge move yet. And if it should move, do we think players like Noble and Olam can be good proxies for this? I think they do fall into the category of proxies, right? But I think again you got to look at company-specific risks, and we don't actually have coverage on Noble and Olam, so we're not experts on the two counters on whether there are further company-specific risks to look out for. But I would say, broadly speaking, yes, they are proxies for a materials and commodities rally up. On the commodities front, actually, we have an accumulate on Wilmer. If you want to talk about, if you want to proxy this move, and maybe Nicholas can share a little bit about a few points about Wilmer.
Right. For Wilmer, we see Wilmer as a good proxy for the growth in the food demand over in the emerging markets. Especially, it has given that it has a great exposure over at the China market, as well as other emerging markets like India, Southeast Asian countries. It has also increasingly increased its exposure over at the Africa market as well in recent years. So definitely, Wilmer is a good proxy if you would like to invest in the commodity market. There's one question on a reasonable price for long in Izion. Well, the thing for Izion, we have a target price of 271, and we believe that so long as new projects are coming in for Izion, the target price should be on a upward trend because of the fact that we didn't model in any new contracts yet. So any new contract should be an upside for Izion's target price. There's also a question on ISRA's costing on project quoted. was not in line with price tender. I'm not very sure about this question. Where are you coming from? But let me share some light on the recent drop in gross margin. Partly it's mainly due to the Zion Subsea segment, in particular from its AMC business, due to legacy projects which are secured before the AMC acquisition by Israel. So all this contract, even though it's not secured by Israel itself, they have to go through. They have to be carried out and delivered, and this in turn has resulted in losses in 3Q. But going forward, we see that Israel may still take some time to fully integrate the business. So investors, you probably have to sit tight for now. Next.
Hi, we have a few questions on when do we think the commodities upcycle will be, and actually I think probably towards the end of the year. That's just my guess right now because we're basically you got to see whether China is going to bottom out or not, and it is our opinion that it is bottoming out, but I think it's going to only really hit the market towards the end of the year when you have at least the third quarter GDP data coming in positive. Now, if you want to be ahead of that, then I think you really have to look at the commodities chart that we are always looking at, right? If it breaks above that downward sloping trend line that we have shown many times, and then you know that actually things are already looking up ahead, because that's a pretty significant downward sloping trend line. I think afterwards Kenneth can show you that line again if you want. Okay, we have questions on QE and economic recovery. So one of our clients here has pointed out that look, if the U.S. economy is doing badly, then we have a prolonged QE or prolonged easy monetary policy, and then that means stocks go up. And then if you have a really good economy, then GDP growth is very good, and again stocks go up. So in either case, stocks go up. And could this mean that the market just keeps going on forever? Actually, this argument that was pointed out has a name to it. It's called the Goldilocks argument. The Goldilocks argument for stocks is basically the situation I pointed out. In either case, stocks will go up because bad economy, lots of loose policy, stocks go up. Good economy, then you have GDP growth, and then again, stocks go up, right? So actually, this is valid, and in investment speak, it's been termed the Goldilocks argument for stocks. And I actually buy this argument to a certain extent that which is why I believe that one of the reasons why I believe that this bull run is not over yet, and has some legs to go. But will it go up forever? Of course, it will not go up forever, because there will come to a point that, let's just say we take the argument that GDP growth does come back, inflation does come back, then we're going to have to start a rate-raising cycle already. And in a rate-raising cycle, for the U.S. experience, it has shown that stocks can still continue to go up for the rate-raising cycle until interest rates are pushed to a point where it actually breaks the business cycle. Then you have the start of the bear market. So we could, from this angle, yes, we could have a very long bull market. Okay, we have a question on whether is it a good time to get into gold, GLD, and we note that yes, there has been a rebound in gold. However, the fundamentals for gold, in my opinion, are not there. Okay, so I mean, if you've gone long gold at the bottom of the sell-off, then fantastic. But I think you should watch the technical levels for any reversal. And if we do start QE tapering in September, I think you can expect that the US dollar will rally further, and that's not going to be good for gold, right? Okay, we have a question here on the capital outflows of the region. How long will this trend continue and how bad will the impact be on the STI? In terms of capital outflows, it's not going to affect the STI as much as the other Asian countries because actually the Sing dollar is a safe haven. Okay, so that's why you have not seen depreciation of the Sing anywhere nearly like Indonesia or Thailand or Malaysia. Okay, so how long will this continue? I think I don't think it will continue for past QE tapering. Actually, I think once QE tapering does start, and then I think markets would have by then pretty much priced it in. What is the trend for U.S. Treasury bonds ahead? We believe that bonds are in a point where it actually could start a significant down move, right? Especially in this part of the cycle where the economic growth is starting to come back, and then you compound that with the fact that the Fed may slowly stop buying 10-year treasuries. I think the outlook for treasuries for bonds ahead is not a fantastic one.
Yep. Hi, this is Lucas again. There's a follow-up question on REITs asking, do you think the upcoming rising interest rate will affect the SG REITs in a very negative way since we have had such experience back in 08? I think that during the 08, most of the REITs actually learned their lesson. A lot of them have either lowered their gearing and or they have hedged or secure fixed rate interest loans ahead of their book. So currently, it really depends on individual REITs. I would say that most of them have actually hedged their exposure in terms of forex exposure, in terms of interest rates, the current interest rate loans that they have. So I would not think that the impact will be that great. Having said that, I think it will be interested. It will be good if you actually look into the individual REITs itself, look at their balance sheet and look at the amount of loan exposure, and actually gain an understanding. Try to avoid those that have high exposure and those that basically are not hedged in that sense. But yeah, I wouldn't. The one-liner answer to this question would be that I do not think that it will be heavily affected. Yep.
Okay, we have a request to look at the commodity chart again, so and as well as the interest rate chart, treasury chart. So let's just do that. Oops, we're getting there. Okay, here we go. Okay, so in terms of commodities, you can see basically that from this move from 2009, the recovery, we've had basically we're in correction mode. So we believe this is a correction for another move up. Okay, and so if you want to know when commodities are going to move up, just look at a trend line that spans across this region here. Because if this breaks to the upside, this will probably trigger the next cycle move up. So if you're wondering when commodities move up, I suggest looking at this chart over here, and just monitor when this actually breaks up. Okay. Second, there's a question answered by Josh just now about treasuries. So just want to let you know that look at the treasury chart over here, and we believe that this could be the start of a prolonged move downwards. So we are actually biased towards the downside. We're waiting for the resolution of this consolidation pattern. Obviously, it can go up or come down, but we are biased towards the downside move over here. And when this starts, right, if this downside move starts, it would basically lead one to suspect that the trend has now changed from a long-term uptrend to a downtrend. Are we done? Okay, thank you. That's all for today. So please join us next week for weekly webinar.